Hello viewers, we are back here for the discussion of the results of the Berkshire Hathaway Annual Meeting, and I have Steven Kiel and Vitaliy Katsenelson with me. Hi, you both.
Hi.
Good. Thanks, Tillman, for having us.
Yeah.
It's great to having you.
Absolutely.
Before we start, I have to give you the disclaimer, because what we are doing here is no investment advice. It's just us giving you information that you can do your own work. We don't promote a stock. We just give you information and you can do your own job. You find the disclaimer also under the video in the description, so you can look it up and be sure that you haven't missed something. So let me start with the questions on our discussion of the results of the Berkshire Hathaway Annual Meeting. If you have a scale from 1 to 10, and 10 is very bearish, how bearish is Warren Buffett?
I'll let you take that one first, Vitaliy.
I think he was, he expressed his bearishness, twice in a different way. The first time he talked about how it seems like if you look at the virus, the possible outcomes, I think he said, like a month ago, it was very wide, but bad of outcomes. And now it's probably not as bad as he feared. I think that's, but bearishness on the economy, I think he's fairly bearish, but I think it's what makes Berkshire is a little bit different from bearishness, so it's like when you and I construct portfolio, right? We don't have the exposure that he has, right? He has the exposure, his operating companies have exposures and insurance companies that you and I don't have. But I think overall he was fairly concerned that he basically what he voiced that he has no idea how this is going to, the trajectory, how it's going to play out. So I think that's probably last 10 years, probably the most bearish I've seen. Buffett, I've seen last 10, 12 years at least.
Still, yeah, I agree. I think, I'm sorry, did you have a follow-up, Tillman?
No.
Yeah, I'd say, if you're going to throw a number on it, let's say 1 to 10, 10 being most bearish, it was definitely around an 8 range, I would think, a 7, 8 range. On the one hand, he praised what the Fed did, and one particular day that he referenced that could have been very problematic if not for Fed actions. And so there's that on the positive side, but on the negative side, back up even before the meeting started. I mean, Munger did not travel. They obviously had Greg Abel there, but Ajit Jain did not travel there either. And, they did back up a few times to see what the auditorium looked like. And there were only a few people in there. I mean, Becky Quick did not travel. She was working from home as well. And so clearly they're taking things seriously. The relationship with Bill Gates and his actions with regards to the virus, I'm sure has a great effect on Buffett's opinion there. And, with the economy as a whole, like Vitaliy says, he has insights across wide ranges of industries that we don't have insights to. He has day-to-day sales reports from a wide range of industries. And he's clearly concerned about that. They have not been making any sort of major purchases. Set the airline sales aside, there were very minor stock purchases in April that he could not even remember. He didn't know what they were, because it sounds like Ted and Todd made those purchases. So we can get into this, I'm sure, later in this discussion, but he did make a reference of being early in 2008, early as a buyer by 4 or 5 months. And it sounds like he doesn't want to make that mistake again. And he wants more certainty before he can kind of at least get some predictability or confidence in terms of entering the market and making major stock purchases. And the overall word and takeaway from my end seemed to be caution.
And also, actually, it's kind of interesting.
Yeah,
this is the first time I remember Buffett doing a kind of slide presentation. And when he was drawing parallels between the stock market decline now and the Great Depression, that was a little bit chilling. But there was one caveat that he made. He said at the time, during the Great Depression, there was no FDIC, and therefore there was no backstop for the economy, for the financial system. And this time around, as you mentioned, Hugh went out and praised Jay Powell because of and so the point I'm trying to make, he draws this parallel between now and Great Depression, and then explains, well, maybe this time is different because of this, because we're not going to have we're going to have ample liquidity. Yeah. So I thought that was a kind of a negative and positive at the same time.
Yeah, good point.
You've mentioned some points I want to attach to. Maybe let's go first with the airlines. How do you analyze this trade, and what is your outlook for the airlines based on what Buffett said?
Well, I think he finally called the Airholics Anonymous or something. He finally called that number, and they listen. I think it shows a great strength of somebody to change your mind. I mean, I think that's he didn't just say, well, I own it, that's why I'm going to own it forever. I think one thing, it was incredibly painful to watch him talk about it, because he felt almost what's a good way to put it? He basically felt like he had to almost apologize to the executives, to the airline executives that he sold their companies. So it was a very painful to see this, because I think Buffett is always very careful trying not to offend people, and by selling airlines, that kind of, he did not want to create enemies, not necessarily enemies, but he did not want to upset those executives. So there was, I could see that, you could see that if you watch it carefully, you could see that. But at the same time, I think he's right. I think their business, it's very difficult to know how the business is going to look like, right? Because we have no idea when people are going to be less scared, right? And so if it takes 3 years versus it takes 3 months, these airlines will look so different. Their financials will look so different, because every day they don't fly, it costs them a lot of money. Anyway, so Steven, what's your take?
Yeah, it's just like he said, there's just too many planes, right? So you have uncertainty. When we came out of major times of challenges for the airline industry, you come out of 9/11, you come out of 2008, 2009 time period, it takes several years to get back to what demand was previously. And, whether it because of government actions, or whether it's because of just consumer behavior looking forward, it's going to take an extended time period to get back to the level of demand that existed before this happened. And it's uncertain how long that'll take. And so, in his case, the Airholics Anonymous comment, there was the, shooting down the Orville Wright's, the Wright brothers plane at Kitty Hawk. It would have been a benefit to all investors. He's made that comment before. It was interesting that he got back into this a couple of years ago. If I remember correctly, I think it was Ted or Todd kind of introduced to him again. And it is a different industry now than it was in the past, because you have so many things attached to these airline miles and the loyalty programs. And it's such a revenue generator for them that it does smooth out the returns. It is a bit of a different industry than it was in the past. But even with that, it is so contingent on demand, on the global economy, on the supply of airplanes. And, it was very impressive to me that he was able to blow out of all those positions in such a short amount of time, because they really started making those sales. It's primarily in April. There were a few sales in March, but he blew out of it in a short amount of time. And, to Vitaliy's point, I completely agree that he seemed reluctant to, he had to discuss it, of course. He felt obligated to discuss it, but he was very reluctant about, he took responsibility himself for the decision. And he was very careful. I think that's probably the better way to put it, to say this isn't the fault of the management that tried they're good people. They've done the best they could. This is an event outside of their control. Because I think he's afraid that, other investors follow him, of course. And a lot of investors did jump into the airlines, some Buffett fanatics and things like that, because he had. And it's going to have some problems, I think, for the stock prices of these airlines, but also they need to raise capital, whether it's through debt, whether it's through equity, whether it's through some sort of, additional government bailouts and those things. When you look forward the next few months, it's going to be very difficult for them. And I think Buffett tried to be very careful about not piling on to that this was a personal decision and his risk responsibility for Berkshire shareholders and his uncertainty. And it might not be something that applies to every investor, or maybe certainly on the bond side as well, the debt side.
Will we also see a hit in Berkshire Hathaway through decline in revenue in precision cast parts?
Yeah, that's a good point. They reference that as well as a supplier to the airline industry. On the one hand, you've got, airline, there's going to be fewer planes built. He made that point. I think we all understand that with what's going on at Boeing at this particular time. Demand is going to be significantly lower for a considerable amount of time. It's going to be uncertain for a considerable amount of time. And there are probably too many planes even before all this happened. So it's going to be issues, for the airlines themselves. It's going to be issues for the airline leasing companies. It's going to be it has been a major issue for Boeing. And it is really quite amazing, though, when you think about the positive aspect of this, that Boeing just had a $25 billion bond offering that was subscribed. I think it was 5% yield, somewhere around that. It's pretty amazing that they're able to do that. But Precision Castpart is a major supplier there. And, there might be some military elements there still, but on the consumer side or on the commercial airline side, it's going to cause a major issue across the entire supply chain. Precision Castparts will be hurt by that, and I think he made that point pretty clearly.
Yeah, no, just think about today. We're not flying because we can't, right? Because everybody's still, by staying at home. Tomorrow, and it's ambiguous tomorrow. We will be not flying because we're afraid. And day after tomorrow, we won't be flying because we're afraid, and because we're going to have so much people won't be able to afford to fly because the unemployment is going to be so much higher, right? So, and so these companies still have a tremendous fixed costs, because they still have to pay for those planes, right? And ironically, despite oil prices being, oil prices collapsing and being at 10 or 20 year low, they don't benefit from this because planes that don't fly don't benefit from low fuel prices. So yes, if you in the last 10 years, you always wanted, as an investor, you wanted to figure out a way to kind of to have stock that benefits from airspace, because you look at this, you look at that industry and you're thinking as the emerging markets, as people become wealthy in emerging markets, they travel more, demand for plane goes up, etc. Now you look at this and it's completely reversed. Now it's actually, if you have exposure to airspace tax in your portfolio, now it's a major liability. The Berkshire Hathaway, the Precision Castparts will be impacted, but he already owns it, right? He's not going to sell it. With airlines, he could actually get out. He could actually sell those stocks. So yeah.
So might we see a new paradigm in the air industry in the next years, or a new state of balances?
Well, okay, I think our senses maybe. So my senses today tell me yes, but then I don't trust my senses as well, because right now I am right in the middle of that, right? Yeah. And it seems like what's going on today is going to go on forever, and it rarely works this way. So it's really a function of how long people will be afraid. That's really, because I would love to come back. I would love to go back to Europe again, and I absolutely love going to Europe. And so if I feel safe traveling to Europe again, I would do it in a heartbeat. Or if I'd like to go on vacation anywhere, just think about it. Summer is coming, and I have one, in the summertime we usually take kids somewhere. Now we can't. So and I'm sure it applies to all of you guys. So today, when we sit today, it's hard to imagine things coming back to normal. They will. It's just really the question. It's really the question of the answer lies in when we're going to have either cure or when we're going to have a vaccine. So that's really what makes the analysis today so difficult, because we don't know the answer to those questions.
Yeah, and from an investing perspective, who are going to be the winners and losers? Some of these companies are just not going to survive. And, you can look historically and say at times of uncertainty, because investors overreact on the negative side during times of uncertainty, that you could say historically that's an opportunity to buy into these types of things. There's a survivorship bias there, though. We remember, hey, this would have been a great investment if I would have bought it during this time of uncertainty in 2002 or 2009 or something like that. But look, the airlines went bankrupt in the mid 2000s. A lot of equity was wiped out. Could that happen again? Possibly so. Could it happen with the suppliers? So it's a difficult time period right now to really say. We have a significant amount of uncertainty. At some point, certainly we think the economy will come back. We think certain industries will become normal. Industries on average will go back to their normal. We don't know when that'll happen. So, fine, we can come from that perspective. But then as investors, who do we choose? What do we buy into? Where is the bottom? Will there be a second wave of this? Or will it happen again next fall? When will this vaccine happen if there is one? When will this treatment happen? And that's where it becomes tough, because you say, well, we're fiduciary, Vitaliy fiduciary, I run a fund as well. And, and if you're managing your own money, early in some cases can not only be wrong, but we're value investors. We generally, if we get in early, we can withstand it. But because of the uncertainty here, there might be another down leg. The market actually has not even dropped as much as it's you would think. The S&P is down 12%. I mean, you would think it would be down much more than that, given what's happened here and the uncertainty going forward. And so, you think of this industry as a whole, airlines, everything associated with it is a microcosm or an example for a number of other industries also. And you say, well, what's investable here? And the answer is, I don't know.
Also, I think so you made a good point about being early. Normally, when you're early, the risk of being early today, I can safely say we never owned an airline. I'm never going to own an airline. So for me, that's an easy decision to make. But let's say in aerospace.
Get a tattoo of that, Vitaliy. Get a tattoo of that in your arm so you remember it.
That's right. No, I like when I found out that Buffett bought airline, I didn't have to think for a second. But I had zero hesitation of just doing nothing. But the point I want to make is that being early in aerospace, being early in aerospace today could be dangerous too, right? If you own a company that has all of its business is tied to Boeing, hypothetically, right? And so if they have no business for 6 months or a year, they may just not cease to exist, even though in a normal situation, it would have been an absolutely great company, right? So the way and I'm not going to mention names, but the way we found a way to play in this, we would buy a company that would have a defense business and some aerospace attached to it, right? Because defense business will pay the bills if we are run on timing. Okay, and so because I think it becomes a very path dependent investment, because if the virus ravages for next year instead of 3 months, then this great company, this otherwise what would have been a great company may cease to exist, or at least the assets will be there, but you're going to have different equity in that whole. You're going to have different equity investors. So
we have a question from the audience, and I'm happy to receive more questions. So just type them into the chat. I think it's on the right of you if you view the stream. It's about Greg. How did you like him, and what kind of insights did he give you that you hadn't before?
I'm sorry, that was for who? For what happened?
For both of you, about the new audience, the new podium, like Warren and Greg.
Yeah, very impressed with Greg, of course. But any of us who followed Berkshire for some time have been impressed. I mean, he is a superstar for sure. We don't get to hear from him very often, but he's done interviews through the years. Some that the real fanatics have kind of watched and read. And he's a very impressive guy. He's understated. He fits into that culture perfectly. And it really should give a lot of confidence to see him up there, comfortable. The interactions with Buffett were, they were relaxed. They were comfortable. He He was confident. He had a high level, obviously, grasp of all of these different details. And, there was a couple of comments in there, I think, that struck me where, he had said something about, analyzing some potential opportunities that had come about. They referred to the interview that Munger did, and Abel made a comment that, he actually has received some input from some potential private investments there that they've set aside. And so, I don't say he lightly rebuked Munger, but he had a higher level of information and knowledge, and he provided it in a respectful way. So I love the setup, but nothing can replace Munger. I mean, we're really looking forward to having him back next year. And Buffett will be 90, but Munger will be 97 by next year. It would be nice, though, to have Abel on the stage also to hear some of those company-specific answers, and to have Ajit Jain up there to really give in to some details with the insurance side. And it would be great for us as investors to hear from Ted and Todd as well. The stage can't be too big, though. But as great as Abel was, it was really good for those of us, those longtime Buffett followers and Berkshire followers, to hear from him. At the end of the day, nothing replaces Munger, of course.
I agree.
Nothing to add.
Yeah, you said it perfectly, Steve.
Yeah.
There's also a question coming from the chat on cruise line industries, and Buffett also commented on the hotel industry. He was bearish on that as well. What is your take on this? Is he right?
I think so. I mean, I think I would trying to think which one is worse, cruise or hotel, cruise or hotel, right? At least hotel, and we can argue about this, but I'm not sure I'm right about this, but I would think that the business travel would come back first, and then the leisure travel would come back second. And I'm not sure I'm right about this, because I'm thinking how much my behavior will change with Zoom, right? How much, are we going to be traveling as much for business now because we have Zoom? So I'm not sure I know the answer to this. But if business comes back first and leisure comes back second, then I guess hotels would do slightly better. You would think than the cruise lines, right? Again, normally I don't have to think like this. Like normally, I'm trying to think being a long-term investor, but in this case, well, this industry will go out. If you can't pay your bills, you go out of business. And if this, and this is not a normal recession. So let me just be noodling this for a while. But think about normal recession. Normal recession, you have economy decline, I don't know, 4%. Like I think during the Great Recession, I think GDP was down 3 or 4% for the year. And that was the Great Recession. That's the recession we are referring to. Well, it's the forecast for second quarter are somewhere between, I don't know, 9 and 50. Like some insane declines for GDP, right? So obviously this now, I think Goldman Sachs was at 35% decline for GDP. So when we kind of come back from lockdown, the GDP will come back up. But I think we're going to be looking up at that 4% decline. It's still going to be like our upside, right? Because I think the restaurants will be more, they'll be open, but the occupancy is going to be very low. The sport events will be canceled. The travel will be canceled. Travel will be, very limited. So in that kind of scenario, like it's very difficult for me to imagine this industries, doing well anytime soon. So.
Yeah, and it goes back to that uncertainty that we keep talking about, and the problem for individual investments is the debt. Okay, the debt service, when they have to roll over that debt. Certainly, the Fed and the Treasury in the U.S. have done a tremendous job of providing enough liquidity to allow debt that needs to be rolled over at this current time to do so. That'll end at some point. But you come back and look, if you're Bill Ackman and you've got this position at Hilton or something like that, that's it needs government help to survive, whether it's from the Fed or some sort of liquidity lifeline to roll over that debt. But that goes back to the strength of Berkshire Hathaway, when you think of how Warren and Charlie have set up the company, that it can be bulletproof under any circumstances. And then you look at all of these other companies across the spectrum. I mean, we can talk about hospitality and things like that as this example, but it's all across the spectrum that they rely on rolling over their debt. They rely on a certain amount of debt. They've attempted to optimize the business instead of making it fully protected. And when you think about these black swan style things that happen, they seem to happen every 10 years or so. So it's not exactly unpredictable. And if you have a certain amount of debt and you need to roll it over and your debt service needs to be at a certain level, and you happen to be in an industry where the next few years, think about, again, hospitality, hotel, leisure, et cetera, the next few years, if you have debt service coming due, you have zero revenue for a certain amount of time, you have crushed revenue for a certain amount of time after that. Boy, it makes it really tough. And you don't want to, as an investor, you don't want to be in that type of industry that you're relying on the kindness of strangers to survive, not just to retain your investment in some way, but to actually survive from bankruptcy. And look, we've seen it in the US a little bit where there's starting to become a backlash to some of these government policies. And when you fast forward 2 years from now, if we're still having issues from the demand side, how many people are going to be comfortable with the Fed 2 years from now, with the Fed still providing some sort of lifeline that was provided on a temporary basis? And we saw that after 08, 09, there was Occupy Wall Street stuff going on 2 years later. And it had a major effect on bank policies, government policies related to the banks. And there's going to be unforeseen consequences here based on kind of populism, in the U.S. And we'll see how it ends up being. But we've had a couple things already with regards to these share buybacks, and Buffett made a comment about that in the political environment we live in right now with regards to share buybacks. And look, that's something in the next few years that could be affected pretty greatly, and that will cause unforeseen consequences, second order effects on capital allocation decisions.
No, it's one thing is kind of that I noticed that I think last year, I forget when, he talked about how he wants to have $20 billion of cash on the Berkshire's balance sheet. And though he would not come, I don't think he committed to a number, but I know that $20 billion in his mind is not enough anymore.
Yeah.
I think he said like even 130 in the worst case scenario would look tiny, which is also
yeah. So and this goes back to we as the United States, and probably it can develop Europe as well to some degree, have been spoiled by prosperity over the last 60, 70 years. And we forgot that there are such things as supply interruptions. We basically we were too fat and too happy. I mean, we optimized our supply chain for efficiency, not resiliency, and we're paying a price for that. And I think if you look at, if you start looking at Berkshire Hathaway through that lens, you realize that, well, yes, it's $137 billion. I think Buffett mentioned that he would be happy to do another acquisition of $50 or $70 billion. I forget the number. Yeah. So if you do the math, you realize that maybe he's thinking his cash that he needs to have for resiliency is maybe not $20 billion, but maybe 70 or 50. So, and I think actually it's a good lesson for corporate America in general. So we rely too much on corporate markets, and maybe we should have, maybe we should be a little bit more resilient and maybe have more cash and less debt. And I think that's kind of the message Buffett communicated a little bit.
Maybe a question to understand that our viewers and I understand the American stock market a bit better. It's on buybacks. Do you think they will be still a strong driver for the stock market? And last year they were.
Well, because in Germany, right, are you not allowed to share buybacks are not allowed, correct? Or certain
we can do buybacks, but people prefer they usually don't do it.
Oh, I see. There are certain countries and certain markets where it's just banned. It's not allowed. And I think in the US, look, that would be very difficult because as investors, we look for for capital allocators at the helms of these companies that make effective capital allocation decisions. And you have to have share buybacks as a part of that. Buffett made an excellent analogy at the meeting. If it was a private business and one of the original owners wanted to exit, and that's essentially what it is. The problem, though, is, to Vitaly's point about the optimization, too many companies actually optimize in that way. They'll raise debt for the purpose of funding buyback programs. They do it at prices that are, not effective capital allocation decisions. But, look, there are certain companies, certain industries that generate more cash than what their needs are. And if you don't allow for some sort of return of capital, then it's going to be very difficult for investors. They're going to make acquisitions. They'll be incentivized to make poor capital allocation decisions in that way. But I think the underlying issue is that the buybacks don't generate taxable income for the government, and dividends do, and that's essentially why it's a political football here, because it's a revenue generator to force capital return via dividends. And it's not that way with buybacks. And there is I think we probably agree too, though, that that's this optimization side to it, where debt is being used to it, and buybacks are being made at prices that are clearly at or above intrinsic value of the companies. Look, I'm not for that either, and those are companies I don't want to invest in. But anyway, that it was a bit of a driver, for the stock market the last few years. But the fact is, a lot of these companies generate more cash than is needed. And if they didn't have that opportunity to return that cash, they had access to the debt markets at low interest rates. And that's a Fed-driven thing. But if they generated more cash than is necessary for their internal uses, what are you going to do with that? They have to use it in some way. And you'd rather have it be returned in some way than to have ridiculous mergers at above market prices.
I think it's a very philosophical kind of discussion, because if the government basically says you can't do buybacks, or when the government starts telling companies what they can and cannot do with their cash flows, basically, just think about it, buybacks is just another way to return capital, right? So suddenly government becomes capital allocator. Suddenly government basically, even those are public companies, they're still private enterprises, right? Just like, each one of us here has a business, and we don't want government to come in and say, I cannot, there are certain things you can or cannot do with money that's not theirs, right? So I think Buffett was right that it's going to be, buybacks been politicized, and there is really no difference between buybacks and dividends. From I pick on ExxonMobil all the time, but it's an easy company to pick on. But I've been doing it before the oil prices declined. But they basically went from a net cash balance sheet 10 years ago to become to go in net debt, to pay the dividend. So most of the money went to pay the dividend. So in this case, the corporate was not the buyback but the dividend. But it doesn't matter; they still misallocated capital because they borrowed money. They borrowed money to pay dividends, and now they may find themselves in a very difficult position. So and I think, Steve, you made a very good point. If the government starts saying you can't do buybacks, then they're just going to create a bubble somewhere else, right? Because you're going to have companies that should never have done buybacks because it just was a stupid decision. It wasn't, it was a bad decision for many reasons. One of it could have been because they bought their stock indiscriminately. They just bought it because they wanted to drive earnings growth. Okay, and they didn't care how much they paid for it. Okay, so that was stupid, right? There was also stupid decisions because they borrowed money to do this, and they basically endangered future shareholders, right? But also now, if you start telling companies you can't do buybacks or you can't pay dividends, they have all this cash accumulate, and let's say now they have cash much more than they need for the even black swan scenario. So now you're going to make stupid acquisitions, because government did not leave you many choices. So, I say all this, and then government is going to be bailing out airlines. So I'm very conflicted about this, because I'm basically saying, this is government, stay away from us. unless we have a black swan and then you bail us out. So it's a very kind of a precarious situation, because we say free markets unless government bail, unless we really need government, unless we really need the Fed to step in. So I mean, I guess, and I think that's the point Buffett made yesterday, that we really have no idea what the consequences of Federal Reserve stepping in are in the long term, because the moral hazard that it's created is absolutely enormous. Just think about it for a second. Let's say you have two bonds. You have a junk bond and you have a investment grade bond. Junk bond, you get 6% interest, 6% coupon. Investment grade bond, you get 3% coupon. Well, basically, if the junk bond can now go bankrupt, if that junk bond company can now go bankrupt because Federal Reserve is always step in, then it's a risk. It's basically as a riskless investment as the investment grade bonds. So just think about the consequences of this in the long run. Anyway,
no, we're propping up like an Argentina style thing for certain companies in corporate America, and that rewards bad behavior from corporate executives and bad capital allocation decisions. And there is a long-term negative with that because of that inefficiency. And look, there's no way around it now. It's going to happen. It's the issue going forward is how is that kind of limited in some way. But the second part of that is there's a political element to it. There's a populism element. It does lead to unrest. It leads to differences or with the widening between the rich and the poor. It just does. And there's a consequence to that. And sometimes that consequence, it could be much, much worse than what the original problem was.
We have drifted a bit, and I want to turn back to the results of the meeting yesterday and maybe ask you how you would analyze what Buffett said about oil and oil stocks.
Well, I think when you buy an oil stock and you only expect oil price to go up, you're very naive. So I obviously nobody expected that the difference between supply and demand will be 30%, right? Because I don't think anybody ever expected that. But still, when you invest in an oil stock, let me contrast it a little bit with airlines, okay? Like in the airlines case, like in the recession, like if in the normal times, like in the expansion, you are maybe operate at 80% occupancy or capacity, right? In the recession, you operate maybe 50 or 60. Okay, zero is not like we never had a situation where the occupancy was was 5%. Okay, so that is so far outside of kind of a normal scenario. Okay, oil prices going to $20. It's not outside of things that did not happen before. So so I think his point was, I got the oil prices wrong. So.
Yeah, and for Occidental, I mean, look, if I remember the question exactly from some of these questions, quite honestly, from the viewers at the meeting to Buffett, fairly aggressive. Becky Quick, she read that question about Occidental, and it was very confrontational.
I think at this part, she said there were even more aggressive questions coming in, and was one of the softer ones.
It's so funny because, and these aren't all coming in from shareholders. I think shareholders are generally more respectful towards Buffett and his history. But these questions, they basically called him an idiot, for buying Occidental or not buying it, but providing the funding for it. It converted to equity. Look, he's going to be fine. Berkshire will be fine with the Occidental investment. It did not work out as planned, but these things happen. Sometimes things work out better than planned. Sometimes they work out worse. The pandemic in this situation is something that, although possible, was, like these other black swan things, unlikely. And so it's just a matter of getting the proper price. And it's the point of the margin of safety. And, Vitaliy and I, we can make investments in margin of safeties that are higher than Buffett can do because he's trying to put $137 billion to work, So there's not these obvious opportunities as out there for us mere mortals. But look, there's a certain interest rate, a certain rate of return that he expected to get from that investment. The investment came to him for specific reasons. There was kind of a competitor there as another buyer. There was a breakup fee, et cetera, et cetera. A populist would say, well, this is an example of kind of a crony capitalism situation. And, Buffett gets access to deals that others don't. Well, of course he does. He's got the $137 billion to put to work. So that's perfectly fine. And sometimes it works out, sometimes it doesn't. But ultimately, I think with that position, you fast forward a few years, when we'll go forward 10 years and look back to today, he's going to have made an 8% return or something like that on that investment. It'll be perfectly fine.
Let me agree with you and disagree with you, because I think it's going to be, I think that actually made this investment even a better investment, because right now he's getting paid in kind in accidental shares, right? So at prices that are not all-time high, probably all-time low. Yeah. So at the end of the day, because remember, he owns the preferred shares. Okay, so if equity gets wiped out, he'll be fine. Okay, but also he's getting, right now he's getting paid in accidental stock that is, that's very cheap. So he may end up being okay at the end. So it's not necessarily from a Berkshire Hathaway perspective, may end up being a very good investment. The one thing I thought was funny, where Buffett explained how he almost doesn't want to wake up in the morning for $1 billion investment, because so what is it gonna? So it's it was a very interesting to hear this. $1 billion investment. So if I double my money and have to pay taxes, it's $790,000 and $1 million. Not gonna do much fun.
Yeah, no, absolutely. And the interesting thing to your point, with Occidental and things look, he has a lot of money he has to put to work, and these opportunities come at him. He has to make a decision quickly. He understands the risk to that investment far better than any of us, far better than any viewer. He has access to information that we don't have access to. He understands that risk. He has a mind, obviously a brilliant mind with regards to risk management, and he decided that it was worth the risk to do, obviously even before everything happened here. And things don't work out perfectly, but to Vitaliy's point, I think it'll work out fine over time. And I think some of these people up in the peanut gallery throwing things from the audience into him, it's a little bit of humility would be a good idea in these situations.
How did you observe it yesterday? I had a certain feeling that this AGM was a kind of also advertisement platform for the big tech companies. He mentioned Zoom a lot. He was talking about YouTube. He used slides like PowerPoint for the first time. So I had this kind of feeling that it was a kind of advertisement. What do you think about it?
I'm looking to Zoom commercials with Charlie Munger. I think that's. Well, I think actually I was very impressed with his slides, because I think he set the bar so low for everybody else now, that now when I come up with slides that took me about 2 minutes to prepare, I'm just going to say Buffett did. I'm just doing what Buffett does. But listen, I think listen, in an environment where you are socially distancing, and where the physical world kind of gets probably impacted the most, and anything that is virtual, like Zoom or YouTube, benefit from that. So I guess that's kind of the nature of the beast today.
This is the best reminder that, look, he's 89 years old. It's clear he's 89 years old when he pulls out the slides. First time in his life he used the slides, and it's just the black ink on the white background. This is how an 89-year-old would use PowerPoint. And then even one slide, he made the reference source. Warren Buffett, W. Buffett's wild guess, essentially. Perfect. You'd love to get to that point in life where, look, put whatever you want on the slide. It's his slide, and people respect that. Look, it was good information. It was important to use slides in this instance, but no reason to use fancy fonts or anything with it.
And did he get his point across? Yes, he did. So did it matter that it was a fancy slide or not? Not really.
It's the information that's valuable. The second thing that I love, though, the reference to YouTube, he said, look, go, if you go to the Sam Nunn video on the YouTube, right? So how many Sam Nunn videos are there? It's like, it's not on a specific channel, you know, it's not on a specific, it's on YouTube, the platform. But everyone will find it, you know, but that's how, that's how, look, elderly people refer to some of this technology. And although he's obviously far and above better than average, it is still, you know, he's still 89 years old. And it was good to hear that apparently Charlie Munger is using Zoom. So I'd love to see the camera angles for the, you know, the webcams there. But no, but going back to your question, Tillman, absolutely. I mean, I wouldn't say that, you know, Buffett in this case was an opportunity for, or, you know, advocating for the kind of the value of these tech companies. But a lot of public companies are using the virtual meetings. You know, I run a small public company. We're using a virtual meeting for our annual meeting this year. When you go fast forward in the future, why should a lot of these annual meetings be in person? They probably won't be. And this is the thing that might cause that shift to more virtual meetings. We, you know, so a lot of companies are doing that. Look, webcams, I read something the other day that you actually get better quality on an iPhone than you're like an Apple computer in terms of the webcam. And so the next generation of webcams and computers are going to be a lot better. You know, I think there's going to be a response from that. Can you profit from that? That's a whole nother question.
Well, it's kind of interesting. I actually flew to a company's, one company's beyond annual meeting in Phoenix. They literally showed up. They spent 30 minutes where they talked about nothing. They went, you know, they went through all the motions, which have, you know, had very little value, and the meeting was over. That was it. But there were so many people that had to fly in, you know, board of directors from different, you know, from different parts of the country for that. How much time was just wasted for that? Just think about it, right? And I think the bylaws will change that will allow you to have a Zoom, you know, kind of a Zoom meeting that so much more efficient and save so much time. So I think one, and this point is not unique to me, but I think the coronavirus has accelerated a lot of trends that were in place, you know, to begin with. They just, you know, and I think so there are possibly some possible side effects from this, you know.
How do you analyze the facts you heard yesterday about Berkshire's energy business?
You know, that's a good question. I mean, that's why it's so great to have Greg Abel on there to hear some of the details and their thought process and things like that. You know, I don't have kind of any major takeaway there other than the fact that Buffett made the point that you don't get rich in this business. This is a way to protect capital, not to and to grow in an acceptable rate. You know, it's not a way to get rich, it's a way to stay rich. And that's where Berkshire is at this point in their life. And as a company, which is perfectly fine, but that is communicated to investors. Investors do need to understand that look, an 8% return is perfectly fine. They have reinvestment opportunities, but they also have to have a balance between what rates are charged to customers. And you know, obviously there's a lot of regulation involved in that and state rules. And so their goal is to make an acceptable return. And it's a way to put a lot of capital to work over extended time periods and make that acceptable return.
I got nothing to add, so I'm going to use that line.
I think yesterday they defined to a certain extent that this is also the kind of edge they have, like capital intense businesses where they can reinvest because they have the cash to do so, and others won't be able to raise that amount of cash.
That's right.
You know, and this is a reason actually for smaller investors, and by smaller investors, I mean everyone other than Buffett, you know, you have to be very careful about just following what Buffett gets into as investments, because he is, you know, that situation is entirely different than the situation for the average investor. Obviously the opportunity set, but also he's in a stay rich mode. And some investors, I'm sure many listeners here are younger, and they're more in a get rich mode in terms of investing. They can take on, it doesn't necessarily have to take on more risk, but they have opportunities and they can take on investments with higher potential gains. And so
also, yeah, that's a good point. Also, there's one more thing. So basically the market, took a 40% decline, over a 2-week period, and Buffett did not do anything, right?
Yeah.
And people look at it and say, and if you analyze this for a second, you realize, number one, this happened incredibly fast. So it's just really you had a window of 2 or 3 weeks. Number one. Number two, he needs to have very large deals. So number three, the Federal Reserve basically made him obsolete to some degree, right? Because the lender of last resort, in this case, actually was the Federal Reserve, not Warren Buffett. Yeah. So I think this is, if you were looking at Buffett's non-action to some degree as embarrassment on the economy, I think it's more complex than just that. I think it's part of it. I think he does, he needs more than $20 billion of cash now to, as a normal cash balance. I get that, but there is also also other factors that prevented him from, that had nothing to do with what the future looks like, prevent him from putting money to work.
Yeah, that's an excellent point. I'm actually going to change my rating of 8 out of 10 in bearishness down to 7, because to your point, Vitaliy, you look at a company like Boeing. I mean, they just raised $25 billion. Now, a lot of that essentially, if you take a couple steps forward, it's backstopped by the Fed, right? I mean, they're providing, but they did not need the government. They decided not to take the government bailout. They raised, a $25 billion debt offering. So they're not going to go to Buffett.
Exactly.
And in a different environment where you don't have that Fed backstop, whether it's Boeing at $25 billion or whether it's a company all the way down to, a $500 million offering that would have been forced in the 08-09 time period to go to Berkshire for 10 or 12% interest in warrants. That's not happened so far, and that's not necessarily an observation on the economy as a whole. That's the situation that the Fed is crowding out and lowering the cost of capital, essentially, or lowering the cost of debt. And so why go to Berkshire and have to pay? Why come and beg to Berkshire and have to pay for it, essentially?
Exactly.
The price isn't that low if you have a deal with Berkshire in this situation, I think.
Yeah, would Boeing? Yeah. I mean, I think Boeing in a different situation. I don't think, I don't know if Buffett would have. He would have taken the call. Of course, he could put like $10 or $15 billion to work. But what terms would he have demanded, out of Boeing for that bond offering or some sort of preferred share situation? It's got to be astronomically higher than ultimately what Boeing got from their own bond offering.
It's very true.
How did you like the metaphor of the Fort Knox he yesterday mentioned in the annual meeting? And isn't it too conservative, this ultra-conservative view he gave?
Which part? Which part? For the next balance sheet, or?
Yeah, for the cash, and they're keeping the stability they want to have. They already have, and.
I think there was a unique issue to Berkshire because it's an insurance company, and I think this is the point he was trying. They'll get like the legal system is going to test what is covered by business interruption insurance, what is not. And since they're the biggest, I guess one of the biggest insurance companies in the world, that risk spills onto them. There is another layer, like another reason why Berkshire Hathaway needs to have more cash. So there's a whole bunch of reasons for that, but that's another reason for that. So again, most companies don't have that risk. So that's an additional risk that Buffett had, that Berkshire Hathaway has.
Yeah, well said.
We have questions on from the chat. One is on dividends. What I've heard is that he isn't a big fan of dividends, and it wouldn't make sense. But if the cash is piling up like that, it's also a question what he's doing with it.
I could see more, and I don't think that's likely in any time soon. But what might be more likely in the future once life returns back to normal with a huge cash pile, and if there's undervaluation in the company at the stock, I could see at some point a large tender offer made, or buybacks being increased, assuming these things are allowed at that point. But think about, fast forward a number of years when maybe, Buffett and Munger are not the decision makers there anymore. It'll be interesting to see how Greg Abel thinks about things, how Ajit thinks about things, and the board as a whole. I could see, persistent undervaluation would demand some sort of action if there's not an opportunity to put that massive amount of money to work.
I think the reason Berkshire Hathaway never, Buffett does not, the Berkshire Hathaway doesn't pay a dividend. It's very simple. When you pay a dividend, basically, when you set a constant dividend, you basically give money to shareholders and say you allocate it, right? Because and Buffett, arguably, the best investor ever lived, and he feels that he's a better capital allocator than the investors that invest in Berkshire Hathaway. So he's not buying stock just to buy stocks. He's buying it when it's cheap. So he also is able to take this money, and even with all the limitations that Berkshire Hathaway has because of its size, hopefully at the time of distress, take this money and multiply it. So I think that's not necessarily a wrong decision for Berkshire Hathaway not to pay a dividend. It doesn't mean that this is the right decision for every other company out there, because as we have learned over the last 10 years, a lot of management, a lot of corporate managements love their stock at any price. So, but I think for Berkshire Hathaway not paying a dividend, at least in this state, today makes makes perfect sense. I think to Steven's point, 20 years down the road, when somebody else is running the company and they decide that their capital allocation is not their core competency at this point, then they may start paying a dividend.
Do you have a takeaway from the annual meeting that is very interesting to you, but that didn't make headlines yesterday? There were a lot of headlines you already discussed, like airlines and stuff like that. Maybe
I have I actually have two things. One is just kind of my own kind of laugh as we're on Zoom calls and there's all these video calls happening. Was Buffett wearing shorts, with the with the suit? I don't think we had a pan out of him like walking in there or something like that. And so, does he when Munger is on the Zoom call, is he wearing pajamas or something like that on them? So, but the second thing that really made me laugh is I think he took a subtle dig at Elon Musk. And in fact, Tillman, you and I were kind of exchanging this on Twitter with a few other people yesterday, that he, I've never heard in all these years and all the things I've read about Berkshire and all the transcripts through the years, I've never heard Buffett make a reference to pot or weed. And he made two references yesterday at the meeting about, well, these were bad decisions being made. Maybe they were on pot, right? And look, the last week we had Elon Musk making headlines. He was on CNBC, these kind of things he said on Twitter, stock price too high, all this stuff. And of course that references back to to Elon Musk's interview on the Joe Rogan show, smoking weed. And there have been a number of jokes that, Musk may have made these comments on Twitter because he was high in some way. And maybe not making the best decisions as to what information to say publicly or not. And there was the issue with Musk and Munger, a little bit of a rivalry a few years ago in some ways. And I wouldn't doubt that Buffett and Munger had a little bit of a laugh at Musk's about Musk being on CNBC and the things he said in the last week. So I'm gonna use that as a kind of a funny takeaway and say Buffett was making an inside joke with Munger.
It's no secret that Buffett has a little bit more money than I do, but I found that one thing that united us, that both of us, his billions did not buy him a haircut, and just like it didn't buy my absence of those billions did not buy me a haircut for 7 weeks as well. So I thought it was kind of interesting, no matter how much money you have, when the economy is closed and barbershops are closed, guess what? You don't get a haircut. Another one, which is actually kind of a history lesson. I did not realize that, which is almost embarrassed for this a little bit, that Louisiana Purchase actually involved a lot more than just Louisiana. It's actually like 1/3 of the country. I mean, it's Colorado, like I live in Colorado, and actually Colorado was part of the Louisiana Purchase. So to me, that was actually kind of interesting factoid. What else? I think him selling airlines to me was kind of and his thinking about it was very interesting. I don't remember anything else jumping out at me.
I'd say on a more serious note, from my perspective, he did make Vitaliy, you jogged this idea for me that, he likened selling the airlines to, he used it as a kind of an example of changed his mind, of course, like that. But that was, in one point, it was in response to a question about closing down internal wholly owned businesses within Berkshire. And that's something that he was much more explicit about than he has been in the past. And it probably refers back to Munger's interview about, look, some of these companies may not open back up, some of the small companies. And, Buffett and Berkshire, they're not going to subsidize some of these small companies that they have. They're not going to subsidize their survival if the long-term prospects are not good. And it was the first time that I've really heard him say almost explicitly that we will sell some of these small businesses that are wholly owned, and we will close them down if the prospects are poor. And to use the sale of the airlines as an example, he used to really differentiate between the stock purchases that those could be sold, and the wholly owned businesses generally would not be, unless there were some very specific instances. And so that was kind of a unique, and I think a new, to be that explicit about it, it was a new thing this year. Yeah,
it's almost like, when he bought IBM, it felt like a lot more like a rental. Yeah. Where airlines, he in his mental account had a different type of commitment to it. I think when he was buying airlines, he felt like he was like, almost like, when he bought the railroad, right? It's almost if he was buying air railroads and he's going to own them forever. Yeah. And I think
well, it's probably why he sold them too, is, obviously he sold them as a whole, but it was a bet on the industry, right? And in some ways it was a bet that the industry is different now than it was in the past. And I think the sale decision was that it's different, but it's still the same 85% of 85% the same, or something along those lines. You still have that supply demand situation, you have the risk associated with it, even though, because of airline miles and the value and the revenue generation from that part's different, but that part does not overcome the similarities of how the industry was in the past.
Yeah.
Have you heard other subtle messages in the talk of Warren? I think he's one of the members of the fan club of Fauci, which was quite interesting to hear. Yeah. And which is also a position, I think, a certain positioning against Trump, which isn't his best friend, I think.
See, Buffett is so great at being subtle. This is why I kind of laughed about the potential Elon Musk dig, because, to Vitaliy's point earlier, he doesn't want to offend anyone. He doesn't take on directly. Because look, I mean, he's very thoughtful. The investors, the shareholders come across all political, look, Munger leans right apparently, and Buffett leans left and things like that. Specific issues are kind of all over the place with everyone. But I do think that was a point to say, listen to Fauci. Don't necessarily listen to some of the other things that might be out there. Fauci is the one to be relied upon. And then he made the reference to Sam Nunn, of course, as well. And certainly with Bill Gates. These are the people who are most sober about this situation and if most responsible.
So basically what you're saying, that you should not consume bleach.
Yes.
Fight coronavirus. Okay, and I think that's the other. But it was a very subtle point. But I think you're right about that. Yeah, I think that's.
He made the point very well, though. And it's subtle, but he got the point across, and I think well said. And look, it goes back to his whole training on public speaking, and what's the book he always references from back in the day, from like
Dale Carnegie,
the Carnegie book.
I think he has a great saying. He has this great saying: you praise person. Like when you praise somebody, you praise by person. But when you criticize by group. So in other words, when he says something negative, he's always going to say about the group. He's never going to single out a person. But when he says something positive, he's going to single out a person. And I think this is kind of this is Buffett being a diplomat, and which I think it's actually. By the way, I think this is a good takeaway for all of us.
And he has to be a diplomat. I mean, he is in a position. He's the J.P. Morgan of our day.
Yes,
he has to be a diplomat. People follow him. He has a massive amount of influence at every level. And the fact that he praised Jay Powell, he praised the Fed actions, he's praised Bernanke in the past. this has an effect, and he's implicitly saying this is what needed to be done, and he agrees with the actions that were done on the Fed side.
And the kind of interesting part, and you and I actually, I think, agree on this, is that he praises the Federal Reserve Chair, and at the same time he says we still have no idea what the consequences are going to be. And I think this is it's very powerful, because there will be a price to pay for that.
Absolutely.
On the business side of Berkshire, do you have a guess what kind of businesses won't reopen in the coming months or years? And how do you see the corona risk related to insurance business of Berkshire? Will they have more write-downs in the coming months?
I think and this is, insurance is not my core expertise, but I think what he talked about, that you have business interruption insurance, and it's going to be litigated exactly what Berkshire's responsibility for that is. On the car insurance side, they actually benefited from that, because we drive fewer miles, there are fewer car accidents. But so that's what businesses will not get open. I was just driving through it, and there was Dairy Queen who actually was closed, in my Colorado at least. I don't know, but so I, and I'm sure, I'm sure See's Candy is going to have, this kind of impact as well. But I'm not sure this is, I'll be honest, this probably matters the least amount for for Berkshire's future, in the long run.
Yeah, any company that would close, it's going to be very, very minor. It's going to be one of the smallest. I would hate to even hazard a guess as well. But there are, you think about some of the Scott Fetzer types of things. These some of these small brands or small subsidiaries, even below some of the subsidiaries that we know the name to. It's not going to have any material effect, and there is the principle of not subsidizing a business that will fail at some point. And I think that's what they're saying. You have to be hyper rational with the capital allocation decisions. And look, that was Berkshire initially, right? He knows he subsidized Berkshire, the actual Berkshire Hathaway, the suit maker, for too long, and it really cost current shareholders a tremendous amount of a return through the compounding through the years, and he doesn't want to make that decision again. And so it's important to make it at a small level, even when it's kind of immaterial.
Yeah, it's almost like there's a difference between providing liquidity, short-term liquidity, and basically continuously pumping oxygen for a company on their own life support. I think that would be the distinction. Yeah.
Yeah, but the operating earnings have increased. Even to set aside the mark-to-market stock things, I think they made $5.8 billion in Q1. That was compared to $5.5 billion, going a year back. And so, it's going to be really interesting to see April, May, June, and Q2. There were comments that some challenges did accelerate into April, and so Q2 year over year you would expect to be lower. It's hard to say how much lower. But even Q1, when you had a month kind of situation there, those businesses are strong. The ones that are major players, major drivers are strong. There's short-term issues that they'll have possibly over the next few years. And we talked about the Precision Cast part. We talked about, even Burlington Northern and things like that. But in the long run, these businesses will survive and thrive, and they have an opportunity to take market share from competitors. On the insurance side, look, it's a kind of a black box. Quite frankly, for us, set aside Geico, that the stuff that Ajit Jain does and Buffett does with Ajit, we'll see when the results come, quite frankly.
Yeah, actually, one comment he made, and I think which kind of interesting. The electricity consumption is down 4%, and just think about from a macro perspective, we are the economy that doesn't manufacture much, right? So if this is but that is actually a significant impact, a significant decline in the economy if our electricity consumption is down 4%. To me, that number kind of stood out.
Yeah. Well, I'll make one last point about the insurance side. He made the point as well that They did not have any pandemic insurance. Obviously, that business interruption, other things like that, but no specific policies. I think with regards to, there's like, I think there's some catastrophic bonds out there for pandemic specific cat bonds that are used as a reinsurance kind of mechanism for certain insurance companies. But he said he would write it at the right price. So it is all about anything will be done as long as you're appropriately compensated for it.
Well, the best time to write the best time to write that insurance is right now, right?
Yep.
Because
yesterday there was also debate about the S&P 500, and let me frame this question with an experiment. If you could choose two investments, one would be the S&P and one would be Berkshire, which would you choose and why?
I would choose Berkshire. Look, the intrinsic value, if you can generally calculate what the intrinsic value is, and as if you're a casual follower, which none of us are, of course, because we're listening to this and watched this, the other day, but casual followers, look to what prices he's bought back shares at. Now, certainly the intrinsic value of Berkshire has declined since he was buying back shares at the B shares at 226 a share. But what are we at? We're in the 180s right now. There's uncertainty right now as to what the intrinsic value is because, but certainly the market went up in April. There's going to be mark-to-market gains in April to that portfolio. But once we get back to some certainty in a normal economy, the stock price has been lower than what his purchase price has been over many years. And you just want a bogey to say, if the stock price is lower than his purchase price over the last couple of quarters, not right now, but go forward a year or two, look, you're probably getting a decent deal. That's a time where it's a better value than the S&P 500 and probably even at prices higher than that. But you don't have to stretch. There's been a discount for Berkshire for some time. I think there's more safety probably in Berkshire as well right now than in the index as a whole.
So I'm conflicted. I really dislike S&P, so that's easy for me. So I think there are a lot of headwinds for the U.S. economy. So when you talk about S&P, you're basically going to have a deleveraging, corporate deleveraging. You're going to have companies bringing a lot of production to the United States, which is going to hit margins. So they said, I think we will discover that this company is, and the stock buybacks are probably going to be, you're going to see a lot fewer stock buybacks, not just for the political reasons, it's just companies will be deleveraging. So a lot of growth drivers of the past will become actually the headwinds in the future. So I'm not very excited about S&P 500. So if you just follow this, you realize the stock market is probably in the top quartile of its expensiveness, if you're going back 100 years. Now, when I think of Berkshire Hathaway, we actually bought the stock during the decline when the market sold off in March. And so obviously I was thinking it's a better buy than, it was a good buy. I am not sure it's as good of a buy as I thought it was originally. Let me explain why, because number one, the Federal Reserve made it a little bit less relevant. So it maybe possibly, I'm not sure about this, it may make it more difficult for Buffett to take to make this $50-70 billion acquisition and create value with that. So I think that's number one. Number two, I think just like for many other companies, they're going to have to keep more cash on the books. So therefore, it's less efficient asset. And also, you do have a whole bunch precision cast parts and other cyclical business inside of it that will be impacted. They won't be destroyed, but they will be impacted. And so, I'm not sure. I'm actually as I was watching it yesterday, I realized I have to go back and to the drawing board and kind of try redo analysis of its intrinsic value again. So I came away from this less optimistic about Berkshire just because of these factors, than I was before. So, but again, so I'm not giving an answer because I'm not saying by S&P or Berkshire, but I'm less excited about Berkshire than I was before.
I think, he made the point, Buffett made the point, look, buy the S&P 500 now. If you're going to own it for 20 or 30 years, you'll be perfectly fine. Because even at the high point, we'll see what the market ends up doing in the future, or the next few years. But even with the high point, if you have that long-term holding period, you'll end up okay. And that is the greatest advantage that any investor can have, is that time arbitrage. If you can extend your timeline, that makes up for a lot of mistakes, especially just kind of general investments. There's positivity and optimism about the U.S. innovation over long time periods. For us, though, and again, viewers here, listeners here, those who follow very closely, look, there's probably better opportunities in either of these things.
Yeah.
I think everyone is generally cautious here about macro type things, but there are specific companies, smaller companies that are within our universe and things that we can analyze that are really tremendous values right now. So I would recommend just to be very selective and honestly set Berkshire aside for now, set the S&P aside for now, and start digging through those filings and finding some interesting opportunities with smaller companies.
Yeah, and this is going to be shameless self-promotion on my part, but I wrote 2 books on the topic of kind of stock market cycles, and my argument would be, so he's right. If you buy S&P 500 today, you'll be fine in the long run, but it's really long run because the starting valuation does matter, because your future return is really a function of your earnings growth, your earnings growth, and price to earnings going up and down, and dividends. Well, dividends put aside, when you buy stocks, when you buy an investment that's expensive, earnings have to work extra hard to overcompensate for the price to earnings decline. And I think so. I'm a little bit from a 30-year perspective, sure, but I think there will be so much better opportunities to a point, to own something else that doesn't have that headwind.
I think the stock picking environment is coming back. There's been this indexation over the last really 15, 20 years or so here, and that's great. That's brought a lot of liquidity into the market. But value investors and stock pickers then have been that's been out of favor. Yeah. And I think this is the time for those active managers to really provide their value to their investors.
Yeah.
I have one question from the chat. I'm not sure if it fits in here, but I try to ask it. It's more on the question of the system stability, and I want to frame it in a way, if we might see problems coming up for the US through the emerging markets, because of a lot of the emerging markets are indebted in dollar, and this might hit the US. If you have an answer on it, you can try to answer it. Otherwise, I would skip to the next question.
I give you my general answer. So basically, it's like if I can paraphrase the question, you tell me if I'm paraphrasing it right. Is the U.S. still going to be the reserve currency of the world? Right? Is that the question? Is that?
It goes in that way, in the stability way, and if the U.S. financial system will collapse, or what the consequences will be. Yeah, it goes in that way.
I think it's, any way you look at it, we are the best house in a not so great neighborhood, and so if you think about, there are several factors have to be present for another currency to be a reserve currency. Okay, and if you think of these factors, it has to be, you have to have a stable economy. Okay, and despite all the problems in the United States, U.S. is probably still have the strongest economy, than other countries. It's less good today than it was even 2 months ago, because now we're going to have $4-6 trillion more debt, but it's still by far the most deep and strongest economy. Then you have to have the size, right? Switzerland may be a great economy, but if Switzerland became the reserve currency, the country would collapse, right? So it has to have the size. Then you have to have a political system, and you would argue that maybe China, could contend on the size, possibly, but its currency is not free floating, and it's not necessarily stable political system, or its stability. It's kind of maybe you would argue it's borrowed stability because it's not a democratic country. And so I think we are definitely every day over the last couple of years, we have been chipping away at the status of the reserve currency, either by what's coming out from the United States politically, or what's happened with our balance sheet over the last couple of years, the last month or two. But there is unless you're going to have some kind of a combination of kind of a basket currency, there is really no alternative to US dollar. So that's, and also, by the way, another factor is, if you want to have a reserve, if you want your country to be, if like the reason China could not have a reserve, its currency as a reserve currency, because you basically have to accept that your currency will continue to appreciate. And if you're an export-based economy, it's going to cripple you. So anyway, I don't know if I answered the question, but I think this is kind of, because the answer is, I think they're still in the best house in a not so great neighborhood.
Yeah, that's a great way to put it. I would just add that, look, the U.S. financial system is as strong in terms of the banking overcapitalization is very, very, very strong right now. And that's really provides a tremendous buffer to this environment. It's completely different than what it was in 2008 and completely different to previous crises.
And I actually, great points, because I think that's one of the points Buffett, talked about yesterday. He said, at least Jay Powell doesn't have to deal with that. Like, during financial crisis, that was the focal point of the problem. That's not a problem now. So, which is a big deal, actually, which is a huge deal.
To put out a last question for our great conversation, what optimistic points did you take away from the Berkshire meeting, and also from Warren and Charlie and all the others at Berkshire? Because well, we are stock investors. We aren't gold bugs who are hoarding gold at home. We want to have growth and prosperity and a good future.
Yeah. Well, I say, look, Buffett's hour and a half or something along that, the monologue in the beginning was tremendous. And I hope that people refer back to that for years to come. And to make the point that the human ingenuity is amazing. And we've reached a point in our history as a species that it's accelerating. And we're able to stand on the shoulders of our past because of information exchange, because of the internet, because of interactions that we're able to do right now. We're having this conversation with you, Tillman. We're in 3 different locations. You're in a different country, and viewers are too. And that's amazing. And ultimately, there's confidence that the right information, correct, accurate facts will win out in the long run, even if there's issues with that in the short term. And human ingenuity is an amazing thing. And as a species, we have adapted and evolved in a way to always want to be moving forward. And so, he made the point that, like, 20, 30 years, we go, this is going to be one of those crises like anything else that's happened in the past. Everything is slightly different, but we'll come out of it in a way that there'll be technological advances, there'll be adaptions, and we're always able to, as a species, adapt and thrive over time. And so, with that takeaway, Buffett reiterated that. His monologue was excellent at giving the history and the newness. He referenced how young the United States of America is. It's only slightly older than Buffett and Munger's ages combined, and to see how much has been accomplished during that time period. And this is, the U.S. is being centric to this, because this has happened throughout the world, and it's happened because of capitalism. That's unleashed human potential in a way that thousands of years did not have that same ability to be unleashed. And so we have to be confident that that'll continue, and it will continue as long as we have the freedom to do that. On a more micro level and a more bottom-up level, my positive takeaway is, as stock pickers, this is an exciting time. We get to find opportunities, potential companies, share prices, things that have been on the watch list for years that might have been indiscriminately sold. We get to take advantage of that. We get our research, our specific knowledge, information, research advantage that we are as individual, into security analysts and individual stockholders and stock pickers can have, now's the best time to do this in the last 10 years. And so that's fun for us. It's fun for me as an investor. It provides value to my, investors in my fund, and hopefully will over the next few years. And so it's fun. It's fun. It's exciting. And it's quite frankly good for the economy as a whole moving out, that companies that make good capital allocation, better capital allocation decisions can survive and thrive and take market share and increase the efficiency and creative destruction and prove that capitalism continues to be the best source of kind of economic approach in the history of the world.
Actually, I think this is a great way to conclude this, because we were there was a lot of pessimism, for the first hour and a half hour discussion. But I think
maybe that's it's realism. We will see.
No, but I think I think the more you focus on tomorrow, the more pessimistic you are, right? Because you are in the middle of this. We are in the eye of the hurricane right now. But once you look past that, you actually realize, originally people talked about how it's going to take 12 to 18 months to make a vaccine. And now we may find out it's going to take just a few months, okay? Which is something that was, in the past would have been unthinkable. So so I was born in Russia. I was born in Russia, and I, only coming to the United States, I realized how powerful, why capitalism works so well, is because in capitalist system, basically our innate drive to survive, okay, is so powerful. And that's, every, individual, we make these decisions every day that you want to get better, we want to do things to benefit our family. And that in itself kind of benefits society. Where in socialism, you kind of, and I don't want to turn it into the socialist capitalist thing, but in the socialism, you try to benefit society and then it's going to benefit you maybe. Okay, well, the point I'm trying to make is that I think what we'll see is that, I think this will, to some degree, it will make, when we get through this, there'll be so many advances and we'll benefit from this so much. I think it's probably going to benefit our healthcare industry because, we're going to learn how to discover drugs and vaccines much better. I think it makes improve our healthcare system in general. And I think the most important point, we'll get through this. And it's really, will all companies survive on the other end? Absolutely not. But I think as a society as a whole, we'll get through this. And I think that's probably the most important message, optimistic message, you heard yesterday from Buffett, And it's like, it's not like 1918 Spanish flu when they didn't even know what happened. In 2 weeks, we knew what the DNA of the virus was. That's so this 102 years made a huge difference in our progress, how we deal with that. So, and you're absolutely right. We can have this conversation, being 1,000 miles apart. Think about that.
Yeah, that's great, and the conversation was also great. So, thank you very much for your time and your great insights.
Well, thank you very much. It was a Tillman. Thank you for putting it together. You're a terrific host, and you do a phenomenal job on the Value Doc.
Thank you.
Yeah, totally agree. Thanks so much. Great talking with both of you.
I hope to have you both back one day.
Absolutely. Thank you.
One day, also in reality, I have to come back to Omaha and
in person.
I'll see you in Omaha. Next year in Omaha. Yes.
Next year. Vaccine.
That's right. All right.
Bye. Thank you very much.
Thank you.